From Kansas State University, this is Agriculture Today. Eric Atkinson here. During the first part of today's edition, we'll talk farm and ranch end-of-year tax management. Our guest from the Kansas Farm Management Association, Craig Althauser. He'll look with us at strategies to consider when income on the farm or ranch has been on the low side this past year. And Craig goes over the important income tax rules changes that took effect with the passage of the tax reform package earlier this year of importance to you producers regarding depreciation, machinery exchanges, and the new qualified business income deduction. Craig will be mic side in a few moments. Further ahead on this week's K-State Horticulture segment, Chuck Otte will offer basic guidelines on attracting songbirds to the backyard during the winter. Plus more ahead on this Agriculture Today.
While many people know hunger is an issue in developing countries, it is also a problem in our own backyards. In 2010, 1 in 7 Kansans struggled to put adequate food on the table. 2 K-State research and extension programs are tackling this problem. The Family Nutrition Program and Expanded Food and Nutrition Education Program reach thousands of Kansans in more than 70 counties. They learn how to eat healthy with a low budget. For more information about these programs, visit ksre.ksu.edu.
You're listening to Agriculture Today on the K-State Radio Network. We're well into the month of December now, and that means tax management time for you farmers and ranchers. So it's appropriate we bring our guest by today to talk about some standard and some new things to consider there as we head down the home stretch of 2018. Craig Althauser is with us. He is a Kansas Farm Management Association agricultural economist based in Northeast Kansas. He, by the way, has a great article on this very topic of income and self-employment tax management for farmers in one of the more recent KFMA newsletters. We'll refer to that again in just a moment. Craig, there are the things that the farmers may be familiar with, but there are some new things here to contemplate in as far as the new Tax Cuts and Jobs Act bringing them to the table, right?
Yeah, that's right. That's right. We have some new tools available to us to help manage the taxes that we're dealing with right now. Probably the newest to us all is the qualified business income deduction, which is a somewhat complex and a bit confusing new deduction that's available to us, but it's valuable. It's very valuable. Basically, without getting into the specifics of it, will give us a 20% deduction based on 20% of the net farm and farm-related income. There are a lot more specifics to it than that. But as you can think, a 20% deduction is pretty valuable potentially.
You bet. We want to dwell on that just a little bit more in a moment, as well as some of the other provisions of that tax act that was passed. But more broadly here, you want to offer some thoughts to producers on lower income tax management in that producers this year, because of various market factors and otherwise, may not see that income as high as they have recent years.
That's right. That's right. And the thought process going into or dealing with and reacting to a lower income year on the farm or ranch when managing income and self-employment taxes is vastly different from how we might approach managing taxes in a higher income year or even an average year. In a lower income year, we want to get away from that mindset of prepaying expenses almost regardless, or being very aggressive in accelerating depreciation via Section 179 expense elections, and really look at our income levels and be willing to even advance income into this year, be willing to forego expenses into the next year, and not being as aggressive with depreciation on new asset purchases and possibly setting them up on a schedule versus immediately deducting them. And in other words, the concept here is just not blindly reducing taxes to the lowest possible level. Mm-hmm. It's more of managing that and realizing that the goal is more or less optimizing after-tax income, not just minimizing the tax bill. And part of that is thinking of this in a multi-year process. What we do here in December is going to directly affect the next tax year, 2019. So we need to really think about that and think of it more economically over multiple years rather than just looking at this one individual income tax return we're working on right now.
Can it be simplified in saying that do the opposite that you would in a good income year? Is that a little too basic? Or?
Nearly so. That's appropriate. Yes, and that's a difficult shift in mindset for a lot of us to handle. But that is appropriate. I mean, I explain to some of the clients, the KFMA members that I work with, the goal of tax management in one sentence is basically to cut off the tops and prop up the troughs. So in a good year, you cut off the top of that year, push it forward. In a poor year, we're actually propping up that trough and trying to bring it up to a more manageable, more reasonable level and setting us up in a better position for the next year.
Have that mindset as we go through end-of-year tax management. Let's get right to some of the particulars. And one of the things in the article that you mentioned, you wanted to point out that in low-income years, avoiding loss on the tax return would be advisable. Explain that.
Yes, and a lot of people may look at the fact that if you have a very low year, say a negative farm income year, it can create what we call a net operating loss or an NOL, which is portable. We can carry that loss forward, and that provision has been with us for quite some time. They've actually tightened it up a little bit and restricted that, but that's not a good goal to have. Obviously, not only that, but when you carry this loss forward, potentially you could carry it back as well. But when you do that, you lose some other potential tax attributes and tools that we have available with us to handle the tax situation. You also, in any year in which Schedule F, that active farm income schedule, is negative, you are not paying any self-employment tax whatsoever. And if you have a Schedule F that is zero and not negative, you're still not paying any self-employment tax. So those last several dollars of expenses you used to drive it negative did not reduce that self-employment tax one bit. So there's not really an advantage to creating a net operating loss in just thinking, well, we can carry that forward. Well, you lose part of it in some cases, and also you're not offsetting self-employment tax in most cases.
So you want to avoid doing that, and there are means of doing so, you point out, right?
Yes. Again, you mentioned just thinking of it almost in the opposite of a higher income year. We want to try to push expenses into the following year if we can. We want to advance income into this year. There are some tools you can use to if you don't like the grain price right now, if you're a grain producer and you don't want to price your grain, but we want to bring in some more income before the end of the year, there's the possibility of borrowing a CCC loan on grain and electing to tax that. So you haven't priced that grain yet, but we brought in some taxable income into this year. So there are a lot of tools out there. Also, in a really low year, you want to scrutinize your significant repairs and improvements and just try to determine if there are some significant repairs and improvements that you have that you can elect to capitalize instead of deducting immediately. Again, not the mindset we're used to thinking of in those terms in a better year, but in a lower income year, we really want to look at that and set those up on depreciation, push those expenses forward in that manner as well.
Well, Craig, let's bring in more from the tax legislation that went into effect this year, applicable to the 2018 tax year. Depreciation, there have been some modifications here that would be of benefit in a low-income year?
Yes, and a lot of people, if they first read about these depreciation changes and the methods that are available to us on the farm, they might think, well, it wouldn't necessarily benefit a low-income year, but in a low-income year in which you're not electing as much Section 179, expense election, or bonus depreciation, and rather setting more assets purchased up on depreciation schedules, there's a bit of an advantage now that we didn't have before, where it's just a little more palatable to do that. Specifically, new machinery purchase now has only a 5-year depreciable life, whereas most equipment purchased in prior years was depreciated over 7 years. So you're going to get it a little quicker if you don't accelerate that depreciation in year one. And also we're able to use a bit more front-loaded depreciation method called the 200% declining balance method. We did not have that available to us in prior years on the farm. And what that does is, again, it just brings more of those depreciation dollars forward to the first couple years of the depreciable life if it is set up on a schedule and not accelerated. Mm-hmm. So these changes really do make it a little more palatable to set items up on depreciation rather than just expensing them via Section 179.
All right, and just to lend more fodder to this discussion point, and taking here from another article in that aforementioned newsletter that your colleagues Chelsea Fullerton and Amy Bowline of the KFMA put together on the new depreciation rules. Under the old law, the Section 179 deduction limit was $510,000, and that was applicable to up to just over $2 million of purchases. Under the new Tax Cuts and Jobs Act, the Section 179 deduction limit is now $1 million and applicable on up to $2.5 million of purchases. So it allows, what they're saying, more flexibility in reaching a desired taxable income if a farmer elects out of bonus depreciation. And on that option, the Act allows for 100% bonus depreciation for new or used property and farm buildings. Prior, that bonus depreciation election was 50% in 2017 and then was set to decrease each following year until it was phased out. This new 100% bonus will be applicable on equipment placed in service after December the 31st of 2017, and it'll begin to phase out starting on equipment placed in service in 2023. So some of these changes may be beneficial to producers, but you tell us others could have potentially detrimental effects in the long run. And after the break, Craig, we want to take a look at that. Our guest is agricultural economist Craig Althauser of the Kansas Farm Management Association. We'll return with Craig shortly here on Agriculture Today.
What is radon? Home exposure to radon gas is the leading cause of lung cancer death in the United States for non-smokers. In Kansas, 1 in 4 homes will test at or above the EPA action level. The Surgeon General recommends all homes be tested and fixed if necessary. Visit kansasradonprogram.org for more information. Test, fix, save a life. This message brought to you by the Kansas Radon Program, the Kansas Association of Broadcasters, and this station.
We're back now on Agriculture Today, and in the midst of a conversation with an agricultural economist from the Kansas Farm Management Association here at K-State. He's based in northeast Kansas. Craig Althauser. Craig is sharing with us some of the finer details of the tax reforms that were passed earlier this year and how those apply to farm income and self-employment tax reporting as you producers go about your end-of-year tax management now. And one of the features of the Tax Cuts and Jobs Act that you think, Craig, producers have to stay right on top of going forward here has to do with farm machinery exchanges. Fill us in, if you would.
Yes, and this is potentially down the road going to be a large problem. We could have some serious issues with this. Specifically what the Tax Cuts and Jobs Act did is it redefined what property is eligible for like-kind exchange treatment. And it tightened up that definition to read that just real estate is eligible for like-kind treatment. And so where that comes into play in the farm perspective is with machinery trades, by and large. And it affects a lot of people. Anytime now when machinery is traded, what we really have on paper on the return is we have a sale of the traded implement and a purchase at the overall list price of the item you're purchasing. You're trading for, I should say. So whereas before all we worried about was the trade difference, and we set that up on depreciation and essentially rolled on, now we are treating the traded asset as a sale. And the purchased asset is we're starting from the list price, not just the trade difference. That may seem like just not a big deal, really, but the problem is the depreciation on new assets purchased is deducted on one schedule, Schedule F, whereas asset sales, the gains arising from asset sales, is reported on a different schedule, an entirely different form on the tax return, and that's Form 4797, and it's treated differently, it's taxed differently. And that's where this big problem can arise.
And a problem that can be averted somehow through strategic trading, to put it that way?
There are it's going to be difficult. It's going to be difficult for most farms and ranches to really avoid this completely. It is. There are some extreme measures out there that are being tossed around, possibly such as creating a separate entity that would own the machinery and handle those trades, and specifically an S corporation, so you could get that away from your individual Schedule F, your individual 1040. But again, that's kind of an extreme measure. Absent that, it's going to be difficult to handle. When you trade, you can imagine when you trade combines, we've got a large sale and then a very large purchase. And the result might be we want to be very aggressive in the depreciation of the purchase to try to offset the gain from the traded asset. The problem is, in doing so, you're often going to drive Schedule F negative because, again, the gain from the traded asset is not reported on Schedule F. It's reported elsewhere. And that brings up other problems when you have a negative Schedule F. It affects your Social Security earnings history, obviously. It also removes the ability to deduct health insurance premiums for self-employed individuals, and also can really restrict the potential for retirement plan contributions for certain types of retirement plans if you have a negative Schedule F.
So this has to be navigated extraordinarily carefully. Of course, one's tax practitioner would be very valuable in that respect.
Yep, absolutely. Craig,
we do want to circle back around to briefly here that qualified business income deduction, the 20%, which seems to be the headliner out of that tax legislation in as far as producers. And you talked about it earlier, in that there are still some unknowns about this yet to be clarified by the IRS, you say. Is this something that producers heading into 2019 now could capitalize on?
Well, the biggest unknowns are specifically what types of business income is related to this deduction. Even more specifically, does rental income apply, or does this income apply toward rental income? The bottom line answer is currently we're not certain. We believe so in some cases, but we're not absolutely certain, and IRS has not clarified that, how they feel they're going to interpret this provision in the Tax Cuts and Jobs Act either. It appears that possibly if you are for example, a share rent landlord, that the income from that activity may be able to benefit from this deduction, even though you're not actively farming. If you're a share rent landlord, that may be an activity to which this qualified business income deduction would apply. But a cash rent landlord, maybe not. Bottom line is we're not certain of that. There are some other real specifics in the nitty-gritty of this calculation as to what items, how we arrive at the qualified business income. We are aware it's Schedule F plus gains from machinery sales and breeding livestock sales, other than capital gains that are reported elsewhere. But then there's some confusion as to whether or not we need to deduct or reduce that sum by the self-employed health insurance deduction, for example, or some other deductions that are on the 1040 and relate to farm income. We're just not absolutely certain of that. So it's kind of confusing, and here we are in December already, and IRS has already released one set of clarifications and how they feel and how they're going to interpret this Tax Cuts and Jobs Act, but we didn't have all the answers in that. They've stated they're going to do so again with some more detail here coming up pretty soon, and so we're hopeful that we get some direction there, but we'll just have to wait and see.
But if it all spills out favorably, it would seem that this would be potentially advantageous to producers.
Yes.
Fair to say?
Yeah, absolutely. And it's not a minor deduction. This is the idea here is that in a roundabout way, we are going to be able to, with some restrictions and some complications here, but we're going to be able to exempt 20% of our farm and farm-related income from federal income tax. And that's extremely valuable.
It speaks very loudly.
Yes.
So many things to think about here, so many complexities, clearly, and most, if not all, producers do this. Close working relationship with that tax practitioner is extraordinarily important here. Any parting thoughts on producers managing end of year now that you would share that we haven't touched upon?
Well, I just think you really want to focus on knowing where you are, as with every year. But it's just becoming more and more important. It seems as if every year we have, whether there's more volatility in the markets, creating more volatility in the bottom line, or a new tax act like this that adds some complications. Again, there are some really nice tools in it that we can utilize. It's a good thing, but it's complicated. And to be able to efficiently and effectively utilize these tools, you have to know where you are and have the information and knowledge available as to how to benefit from these tax attributes and tools that Congress has given us, and working with someone, a tax professional, in that manner that really has the experience and knowledge in these areas, particularly in the farm and ranch sector, is going to be more valuable now than ever.
And a not-so-subtle plug for what the Kansas Farm Management Association can bring to the table in that respect here, right?
That's right. Absolutely. We work so closely with our operations and the member families that we work with that we're in a position to know their operations, know their families, where they're at, and also, again, back to that multi-year thought process of tax planning and tax management. We work closely enough with them that we kind of know where they're going and where they've been, and that's very helpful now.
Well, producers, if for some reason you aren't familiar with the Kansas Farm Management Association and the multitude of services it can provide to members, you can learn directly all about that at the agmanager.info website, which has a link to the KFMA. Also, have a look at the article that Craig has written up on the topic of choice today on income and self-employment tax management, and covering some of the finer nuances of the Tax Cuts and Jobs Act, which was passed earlier this year, now applicable to agricultural producers. This is in the September 20th electronic newsletter out of the KFMA, and go to agmanager.info likewise to access that. Craig, you and your associates across the state of Kansas will be hard at it from here forward as the tax season really ramps up in earnest here. So appreciate you sparing a few moments to visit with us, and thanks for coming by.
My pleasure. Always good to help provide some information out there.
He's Craig Althauser, and he is a KFMA agricultural economist. He's been based for many years in northeast Kansas, serving producers in that area. agmanager.info with full information on the KFMA. Once again, do check that out. You're listening to Agriculture Today, and we'll be back after these moments away. This is the K-State Radio Network.
Did you know every Kansas farmer feeds 128 plus people?
Kansas farmers are hard workers, dependable, authentic, and sensitive.
Not only do farmers put food on your table, but they put clothes on your back and fuel in your car.
For more information about Kansas farmers, visit K-State Research and Extension online or stop by your local extension office. This message has been brought to you by the K-State Animal Sciences Leadership Academy participants.
We're back now on Agriculture Today, and for you this week's K-State Horticulture segment. And the focus this time around on attracting songbirds to that home landscape. With us, Chuck Otte. Chuck is a research and extension agricultural agent for Geary County. He happens to be also an accredited ornithologist, so he knows his way around birds and enticing them into the home setting. Chuck, folks simply love to do this. It's a great hobby, great activity for the winter.
It absolutely is. There's not a lot of expense initially with it. Some people get rather addicted to it and buy more and more feeders and more feed. But it's something that it's multi-generational. You know, the kids, the parents, the grandparents can sit around on a cold, snowy morning on the weekend and watch the birds coming and going to the backyard and to the bird feeders. So it's something that really brings the family together. They're looking at nature. They're looking at the real world. They're not looking at a screen. There's a lot of benefits to backyard bird feeding.
And here in Kansas, one can attract quite an assortment of birds, can they not?
Absolutely. We have a very good set of birds that will come into our backyard bird feeders in the wintertime, year-round actually. Everybody's favorite, the cardinals, but the nuthatches, the chickadees, the juncos, the blue jays, which may not be some people's favorites, but it's just an ongoing changing faces at the backyard buffet line.
On that particular point, they will hang around if one provides adequate sustenance on a regular basis, right?
Absolutely. I tell people that birds have the same needs as people. They need shelter, they need food, they need water. They need protection from the weather, protection from predators. They need water, which in Kansas in the wintertime can be a real challenge, so a heated bird bath can help. And then we need to put the kind of feed out that the birds that you want to attract are going to eat and present it to them in a way that is going to really entice them to come in.
Well, let's look at the options for feeding them, what products are out there, sunflower seeds, mixes, how to know what to use to attract the birds you prefer to bring in.
Most of these birds are going to want an oil seed, something that's high in oil, high in protein. What we find over the years is that the number one preferred food source for virtually all birds that come to bird feeders is black oil sunflower. So get yourself a hanging feeder. You can get a tube feeder. You can get a hopper-type feeder and fill it with black oil sunflower seeds. Sure, it's going to be a little bit more expensive than mixes, but a lot of the seeds that are in those mixes, if you put them in a hanging feeder, the birds are just going to throw it on the ground because that's not what they want. So that's what we start with. Then we can go on to specialty feeders. We can get the small little tube feeders with little oval slits in them and put the Niger thistle seed in it. Goldfinches, pine siskins have small little beaks they can get in there. The big piggy things like the house finches and the cardinals can't get in there to get to it. So that kind of gives a separate feeding opportunity for those. From there, the sky's the limit. You can put platform feeders elevated, platform feeders on the ground. Things like the juncos, doves, a lot of the sparrows. And I don't mean house sparrows here. I mean real sparrows, Harris's sparrows, white-crowned, white-throated sparrows. These are birds that want to be on the ground. They want to scratch around. They want to get down to that little fine little white round seed called proso millet. Even wheat, milo, corn, cracked corn, they'll eat this, but they want to be scratching around on the ground. It's just how they eat. So we can go beyond that and start looking at feeding soot, rendered animal fat. That's normally in a block form, put up in a feeder some way. Woodpeckers love this kind of thing. They'll come in, nuthatches, chickadees. As it gets colder, more and more different species will feed on the soot because it does provide a source of food that gives them a lot of energy to keep those little bodies warm.
Now, Chuck, sensibly enough, folks want to put those feeders at a place where they can look out the window and see the birds and monitor their activity. Does one need to be careful about that, though, making sure the feeders aren't close to an object to the point of making them accessible to things other than birds?
Absolutely. I have problems with raccoons and possums getting into my ground feeders all the time. That's just a fact of life. Then there's those four-legged little rascals known as squirrels that are always causing problems in my feeders, and they just taunt and torment me. I tell people, just understand you will have squirrels at your feeders. There is no such thing as a squirrel-proof feeder. But there are some feeders that we can try to reduce the chance. There's feeders that have large cages around them that protect the little birds from hawks, birds of prey. The thing that I point out to people is simply have a lot of cover out there. Birds have alarm calls that go across species lines. If a junco gives an alarm call, all the birds are going to react to it. And it seems that the alarm calls are specific as to whether it's an aerial threat or a terrestrial threat. If it's a cat coming in, all the birds go straight up. If it's an aerial threat, a small hawk coming through, they dive into the thickest cover they can. So use fine-stemmed shrubs, use evergreens, use junipers, boxwoods, hollies, anything like that, just to have a variety of cover fairly close by.
That really needs to go into your landscape planning, thinking ahead to next spring.
Absolutely. And that's what I say. It's the best thing you can do to attract birds to your yard is to have diverse landscaping. And look at this. But, we're in the Christmas season now. If you've got a real Christmas tree, as you take that Christmas tree down around New Year's Day, take it out and throw it on the ground near the bird feeder. Birds will be in it immediately, and it provides shelter. It provides protection.
One last thing here, Chuck, keeping those feeders filled to assure that the birds not only make routine visits the first time, but come back?
Absolutely. People will sometimes get concerned. I'm going to be gone for a week, and I've been feeding the birds. What should I do? And I say, well, fill them up before you go. But your backyard is just one stop on a huge buffet line. Mm-hmm. If there's no food there, they'll go on. When you come back, fill up the feeders, and they'll be back to it immediately. And you don't have to quit when you get to spring, too. You can continue to feed on through the year. I do. I don't have as many feeders in the summertime, and I switch over to hummingbird feeders, but that's a talk for another day. But, yeah, just keep them feeding and realize that this time of year, there's still a lot of natural foods out there. So you may not have a lot of activity unless the snow covers up the food sources, and then you'll have a lot of activity until the snow goes away. As we go further into winter, we start getting into February, March, and April. There are no food sources out there for a lot of these seed eaters, so that's when we can get some of our heaviest use at the bird feeders.
And we don't want to let you go without letting people know that you have authored a series on the part of K-State Research and Extension on backyard birding guides, feeding the birds, food selection, strategy on feeder placement, the whole thing. And that's available to folks out there, right?
It sure is. You can go to GearyCountyExtension.com, look for natural resources, and you'll find your way there. Or just give me a call at the Geary County Extension office, and I'll get them to you any way that we need to.
Always a pleasure, Chuck. Thank you.
You're welcome.
Chuck Otte, Research and Extension Agent for Geary County in northeast Kansas. Once again, ideas there on maximizing your enjoyment of your backyard bird feeding through the winter on this week's K-State Horticulture segment. As always, thanks to you for listening in. Eric Atkinson here. This has been Agriculture Today over the K-State Radio Network.